Everywhere you look, either you see, read, or hear that the US is decoupling from China. However, that is not necessarily the real story. And so that's what I want to cover in this video. So guys, as you smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Now, there is truth to the claim that the US is decoupling from China. That is not up for debate. However, the point that I want to point out in this video is that not everybody shows you what the data looks like when they talk about the US decoupling from China, because there's two things happening at the same time. There are certain products that are under tariff that are decoupling, while simultaneously there's other products that have never been part of the tariff that are actually increasing. And so net, it looks like there actually hasn't been any material decline. But don't take it from me. Let's get right into the data. So you can see here, this is from the Peterson Institute for International Economics. And so you can see here in their title that they're saying that the US imports from China are both decoupling and reaching new highs. And so the question I ask is, why are imports from China actually up after years of tariffs? And so let's actually get into that. So you can see that it's actually a tale of three different groups of products. So you have list 4A of products that are under 7.5% tariffs, and those actually look to me like they're kind of holding steady, but we'll get into the data a little bit more. Then you got lists 1, 2, and 3 that have 25% tariffs on them, and these you can see have declined. And then you see no trade war tariffs on this a group of products, and you can see that that is absolutely ballooned. And so you really, what it is you're getting an offset from anything that's declining from list 1, 2, and 3. You're getting an offset from things that are not on the list. And so that's why overall you actually have gone up in terms of imports into the US. And that's very important to understand. And once again, I'm not going to tell you what to do, and I don't push investing in China over pushing investing in the US. In fact, the significant majority of my portfolio is in the US and a little bit in Canada with Canada Goose. But the point that I'm trying to make is that if you're going to push the argument that the US and China is decoupling, based on the data that we're seeing right now, that is not the case in terms of overall imports. And so how does that impact the Chinese economy? Obviously, the Chinese economy remains strong and important. And then, of course, add to that the fact that global exports from China are actually increasing, because not every country has import tariffs on China. And so you're also getting global import or global exports out of China to countries other than the US continuously increasing over time. And so this all aids to the country's overall growth. Now, do I believe that China is going to go back to double-digit GDP growth? Absolutely not. But can we believe that it'll be in the 4 to 5%, maybe even closer to 6% over the next, or at least for the remainder of this decade? I think you can reasonably assume that. And so looking at the data a little bit more, I wanted to go to the 25% tariff items first. And so you can see, and I just summarized it here, that in 2022, Chinese imports of products that are still facing trade war tariff rates of 25% remained nearly 25% lower than their pre-trade war levels. And so you can see that here where the number has just declined. And so the next question I would have, and I did have when I was looking into this article, was what exactly are these products? And so there's 4 groups of them. So the first group, of course, is selected IT and hardware and consumer electronics. So you can actually see that the imports from China were growing, and then they really fell off. Mexico, Taiwan, and the rest of the world really took its place. And so you can see that just surge afterwards. And so the next part is the auto parts. Notice how auto parts are still growing in terms of exports out of China. That has pretty much stayed the same. However, more and more parts are being sourced from Mexico and the rest of the world. So it's actually growing at a rate faster than China. And this makes sense because one of the issues that we saw during COVID was that auto manufacturers were not able to get chips out of China because of lockdowns. And so I think it makes a lot of sense to diversify where you get your products from. Now, do I know for sure that, a lot of this shift or sourcing from the rest of the world or from Mexico is chips? No, I don't have that deep level of understanding, but I would think that as an auto manufacturer, you just came off a situation where you couldn't get chips. And so you'd want to set up a situation where you can source them from the rest of the world. Also, there was a lot of parts backlog as I'm aware as well. And so, of course, you'd want to diversify where you source that from as well. And then the final two categories, of course, is furniture. So you can see that Vietnam has really taken over, and of course, the rest of the world has as well. The amount being sourced from those two areas has absolutely surged, and it's caused the rest of the world line to surge relative to China. China has not come back to their pre-COVID levels here. In fact, they were going down before COVID. They've surged up a little, or they've come up a little bit subsequent to, but part of that might just be going back to where it may have leveled off anyways. And then semiconductors, you can see, interesting that the semiconductor imports still continue to grow out of China post-COVID, but you can see that the rest of the world has taken a big chunk of it. The rest of the world and in Taiwan have taken over it. But, I think that this is still a ways away before you can give up as much reliance on China as the U.S. currently does have over their semiconductor imports or exports out of China. And so this is a better chart to just show you guys exactly how it's looking where you compare China against the rest of the world. So notice that right after the trade war kind of started, the products being imported from China just declined significantly. And then, of course, you had the global trade collapse because of the pandemic. You're seeing that right here. But notice post-COVID, you would think that it would potentially recover if the trade war ended, but that doesn't look to be the case. I mean, there's been a little bit of a recovery, but notice that the rest of the world has surged considerably relative to China. And, part of this is stuff that I was talking about previously on the channel where there's some friendshoring, the diversification of sources, et cetera, et cetera. So I expect this to happen. However, the point that I'm trying to get across here is that it's not the end of the world in terms of exports out of China. They're still they're still exporting into the US. You see that overall the volumes are still at the same levels, which if we go back to this chart, you can see. And of course, what's keeping them at these levels is these no trade war tariff items. They are up 62% from 2017. And so that's the other extreme that we're seeing here, where the US imports of Chinese products that were never hit with trade war tariffs are increasing, and the value of these imports have grown so much that they nearly outweigh the decline in imports from China of products hit by trade war tariffs. And there are few signs of decoupling for many of these products, and so this is what's holding the fort here. And so I just want to clarify and show the whole picture that yes, there's certain items that are decoupling, but there are more than other items that are making up for it. So just keep that in mind as you guys think through the China export thesis. Now, I'm not saying that China doesn't have problems. I'm not saying that the economy is going to go back to its glory years of double-digit GDP growth. I'm not saying any of that, but what I'm saying is that it's not doom and gloom. And the reason why I'm saying that is because I see a lot of videos on YouTube. I see a lot of news reports coming out that's saying, China's going to fall off a cliff. And that's not the case at all. In fact, China, from any source that you get, any reputable source, I would say, their GDP is expected to grow at a rate faster than the Western world, at least. And so, the country is still growing. Yes, they have a property issue. Yes, they have an aging population issue, et cetera, et cetera. And these issues are going to have to be worked out, I would say, in the next decade, if not sooner. Like I would hope that they'd come up with plans within the next 3 to 5 years, hopefully. But, we'll see how things come around. It's really difficult to plan for an economy with 1 billion plus people. And so, some mistakes get made, some things get done well. So we'll see how it all plays out. And just rounding off the research, you can see that the third list of imported products, the list that are being, the list 4A, which will have the 7.5% tariffs, it looks like it didn't really materially impact them because the level is pretty much the same. So it's only this list 1, 2, and 3 items that are have come down. Otherwise, everything else pretty much has stayed the same. And it looks like the US has begun to shift sourcing for some of these products, such as clothing and footwear. However, don't be confused, because for some of these products, new sourcing, the trend actually predated the imposition of the trade wars, and so they're happening for other economic reasons. So just keep that in mind as you read these articles and you see these YouTube videos of calling for doom and gloom for China. And so overall, let's take a look at that list of that 7.5% tariff items. So you can see, yes, the rest of the world is growing, but also China has been growing as well, just maybe not as fast. I don't know. It looks like it's hard to tell right now, really. So give it another couple of years and we'll see exactly what happens, just because the disruption from the pandemic really distorts the data a little bit. But you can see that there's a clear trend of more and more being sourced from the rest of the world. And let's dive into some of these products. There's 4 major categories that I do want to show you guys. So the first category is clothing and footwear. You can see that the rest of the world has really surged here. And so, will China come back to at least 100? So like even themselves out? I think so. But I think the rest of the world is really surging here. PPE products, I think this is down overall. You had the COVID surge, but notice it's interesting is that the imports from the rest of the world have declined slower than, of course, China. But we'll see how that plays out going forward. I just think this is a lesser of importance category going forward. And once again, you got another product that's probably less of an importance post-COVID lockdowns, which is exercise equipment. But notice how same story with the PPE equipment. It's just down less at a lower of a rate than China. So that's very interesting that the rest of the world is holding strong. And then, of course, if we want to shift towards a sort of like carbon neutral economy, et cetera, you're going to have to import a lot of lithium batteries. And the king of exporting these lithium batteries is China. Look at the increase just in the number or just the amount of lithium batteries that we've been importing from China. And it doesn't look like it's slowed down even in the face of the COVID lockdowns. And so, there are some dark spots, of course, but there's some real bright spots, especially this future-focused technology item right here. And I don't know if you can source this from the rest of the world at the level that you can source it from China. Some of you who are smarter than I am, and probably most of you guys that watch this channel are smarter than I am, let me know in the comments below if there's another place where you can easily and cost effectively source lithium batteries. And then just going into the China GDP forecast, you can see that, I always say that China's GDP is going to grow somewhere north of 5%. And I'm not just making that number up. This is from the OECD Economic Outlook. You can see that 2023, the GDP is expected to grow at 5% post-lockdowns. 2022 was really impacted by the lockdowns, and it's not expected to materially slow thereafter. You're still seeing 5.1% expected in 2024. And, China has the ability to assist their economy if they need to. They don't have the same level of inflation impacts or inflation scares that we do in the Western world. And so they could presumably lower rates, etc., to help their economy along. Now, I don't want to say that everything's great. I always try to match some optimism with pessimism on China on this channel, because I try to be as sort of like level-headed as possible. And like I said to you guys before, you always have to diversify accordingly, because despite the expected recovery, I don't know how to spell expected for some reason, but despite the expected recovery, risks to the economy still exist. And so what are some of these risks? Well, you can see that, export growth will be driven by the global need for equipment for the energy transition. We saw that with the batteries. However, notice that, the OECD is saying that longer term growth prospects have diminished as the population ages, constraining the strength of the recovery. I think, maybe, but I think they can find ways out of this through technology. But they're not wrong, right? The population is aging in China, and there are segments of the population that retire sooner relative to the similar segments in the rest of the world. For example, women in China. Now, issues that they're facing is, they have high unemployment, especially for the youth, and I'll cover that in more detail in another video. They do have slow job creation and a more gradual recovery of consumption, which remains a downside risk. I would also say that they have that property issue, and so they're saying it here: continued credit events and disorderly deleveraging in the overstretched property sector may trigger failures of smaller banks and shadow banking institutions. And so you are right. The other issue that they have is that they have a lot of promises by the government, but they don't have the taxation system there to pay for it. And you can't rely on the current taxation system that relies heavily on the sale of land leases in the country. And so just be aware of this stuff if you're going to decide to continue to invest in the country, do your research, do your due diligence, but remain sort of like, or at least understand what you're investing in as it relates to China. So I'll leave it there for you guys now. If you missed my last video where I did a full walkthrough of Alibaba's results, you can get to that video right here.